Hey everyone, me Kevin here. In this video, we're going to talk about a problem with some data that's coming up, which is not so great for the market, but we're going to also talk about some of my favorite stocks going into this evolving market that we're going to be expecting over the next 12 months. Now, the first thing we're going to talk about is Black Friday sales data. Then I'm going to talk about 10 to 15 stocks that I'm going to be paying attention to or not paying attention to for a very particular reason as we go into next year, and encourage you to share your commentary down below as well. But let's take a look at this. First of all, early Black Friday data is out. Final data will not be out until early 2022, but there are many mixed estimates, okay? So right now, you've got indications from MasterCard that Black Friday in-store sales were up nearly 43% compared with the same time a year ago. This is not too much of a surprise since we were still in the midst of a pandemic last Black Friday. In fact, we were in the middle of a winter wave, so that's not very exciting. This was actually more concerning here. Adobe's current estimate for online spending was $8.9 billion for this Black Friday. That is actually less than last year, is at the lower end of expectations, and is the first time that we've seen a reversal in the trend of online spending. Now, this could potentially be because people have been spreading out their purchases. More people have bought stuff before Black Friday, that they weren't just waiting for Black Friday, and maybe we saw less sales than expected on Black Friday. We also saw Thanksgiving Day sales come in flat at a sign of at a total number of $5.1 billion. Again, reiterating that potentially people, because of fears of supply chains or whatever else, have moved some of their spending upwards. Now, online sales, according to MasterCard, though, and this is where the data is a little confusing, according to MasterCard spending polls, Black Friday online sales were up 10.6%. So you've got Adobe projecting a miss, the first decline ever since last year. We were at 9 billion online, and accordingly to Adobe now we're at 8.9, and MasterCard saying we beat slightly. The point here is, while we're not seeing consensus, it's a sign that we're not beating expectations across the board, which is something honestly I expected. I expected to blow these estimates out of the water. I thought we were going to have one of the biggest Black Fridays that we've ever seen, with the amount of money that people have right now saved up either from the wealth effect of stocks or real estate or leftover stimulus or whatever else. And so this is making me kind of wonder, hey, wait a minute, maybe we've got to pay attention a little bit to a shift in what might come next year. And this is an interesting one. So first of all, we know that right now we're expecting inflation, month over month. At some point, though, next year, we do expect businesses, whether or not supply chain issues have completely resolved themselves, we do expect businesses to have much more inventory, to have a lot of product, and people certainly expected to have less money next year than they did this year, especially if they were relying on any kind of pandemic relief-related payments. And so this is leading me to wonder, maybe for 2022, it's time to really focus our investments, not financial advice, of course, but potentially our opportunity to focus our investments on margin plays. Really important. The reason I say that is, if consumers already right now are spending their money, they're kind of spreading out their spending, and we're seeing unclear mixed signals for Black Friday, then that's a sign that spending in 2022 might not be as violent as we potentially expected, especially coming out of the end of this year, where we were expecting crazy spending. And if it's all getting buttered out more and people have done their spending, it's not all getting consolidated on Black Friday, Cyber Monday more, or people are taking a little bit of a breather on spending, which we've been doing like crazy, then we're going to want to look at companies next year that have potentially more product to sell or more whatever to sell, but potentially face the risk of having to lower some of those prices to be competitive, to try to prompt those sales, to get people to spend the leftover money that they do have in 2022. And this is where I believe it's really important to look for margin plays or companies that have a room to actually discount prices, because when they have room to discount prices, it means they can remain competitive. Companies with very, very low profit margins, net profit margins, might be a little bit more beaten up next year. Now, we are already seeing some companies get beaten up this year that have very, very low margins, like Redfin or EXPI, but that could be because of the real estate cycle, so I'm going to kind of like put them aside. I think there are a lot of interest rate fears for these particular stocks. But here's some examples. So Etsy right now sits at a 25% net margin, and it's expected to grow over 18% for the next 5 years. I think this is actually phenomenal. Now, Etsy makes a lot of money really in not just commissions from store owners, but also advertising, right? Advertising to grow their business. So it's not exactly directly product sales, but still their net margin sitting at 25% means even if their cost of labor goes up a little bit, they still have the buffer of a nice fat margin. So I think this is really good at Etsy. Enphase has growth expectations of over 25% through 2024 with net margins around 22%. That's because they get into the higher margin products like inverters and batteries compared to getting into solar panels, which they don't do, which are extremely low margin. See, I would be more nervous for solar panel manufacturers as those margins get squeezed, but inverters and batteries have much more room in them. Here's another one, PayPal. PayPal's expecting growth of 18% through 2025 with a 22.4% net margin, not gross margin, net margin. It's really good. Visa is expecting 12 to 15% growth through 2025. Listen to this one, folks. Visa has a 53% net margin. They bring so much freaking money to the bottom line. Out of all the companies we're about to talk about, Visa has the highest net margin. It is crazy. And both Visa and PayPal have sold off recently. PayPal is selling for 26 times 2022 expected earnings. Visa's sitting at 28 times 2022 earnings. So honestly, both of these companies, for just a 1 year out PE, not incredibly expensive. They've recently sold off. They've got incredible growth. Visa expecting to grow a little slower than PayPal, but that margin at Visa, 53%, my goodness. Now, some folks think that maybe companies, the payment processors like PayPal and Visa might be selling off because blockchain might come in and start robbing them of some of their business. But I expect PayPal and Visa will actually incorporate and adopt blockchain. So I'm not too worried about their capabilities of innovating in this space. Money-losing companies also expected to be out of favor in going into 2022, as labor costs might go up, then research and development costs go up, product costs go up, service costs go up, whatever, data center costs go up. Then you become basically a money-losing company that just loses more money. These would be companies right now, and this is not to bag on them, it just is what it is. Companies like Palantir, Lemonade Insurance, Affirm, they're all expected to lose money and probably lose more money. Now, one of the things that I like about Palantir is that long run, phenomenal company. It's going to be about 5 years to really grow them, though. Lemonade, they're betting on millennials. It's probably going to take 10 years for that bet to start paying off until millennials actually start buying homes, more homes. And Affirm, well, they might be a money-losing company. If people have less cash in 2022, they're more likely to use Affirm, which I don't know how we feel about that from maybe like an ethical point of view, because it's like kind of like, man, so what you're saying is sell to the people that have no money, right? But I mean, okay, that's sort of the business side, and then there's the other. Oh. But anyway, growth expected of over 40% through 2024 for Affirm, which is really good and kind of shows the projections that the street does expect some big growth there for Affirm. Ironically, folks, Zoom gets pooped on all the time, but they're expecting 18% growth through 2025, net margins of almost 30%. They're only they're selling for 27.8 times 2025 earnings, so you're really kind of projecting out to 2025 on that one. Not bad for a growth company. 18% growth, though, could be a little better for that, a little higher on the PEG ratio here. Then we've got Google with growth exceeding 14 to 16% for the next 5 years, expecting net margin, though, 33 to 36%. Really, really, really good. Now, Tesla has low net margins, but impressive gross margins, and that's because they're really early on the S-curve. And so just compare gross margins of, for example, Tesla to Ford. Tesla sits at about 30% without regulatory credits for gross margins. Ford sits at just 15%. So a lot more efficiency over at Tesla. Of course, we got some work to do to get the bottom line moving up, and that'll come with scale. Square is expecting average growth of around 25%, margins on the low end. Out of the payment processors, really on the low end for Square, just 5 to 6% net. Now that could be because Square includes a lot of Bitcoin purchases and sales in their total revenue, and so it skews the numbers a little bit because they actually lose money processing a lot of their crypto transactions. It's probably why this number looks so low, so probably can't do a direct like-for-like comparison between Square and Visa and PayPal for that reason. It does make the analysis a little bit more complicated, but it is something that, if you got hedgies just looking at that bottom line number, it is something that's a little bit of like a eyebrow raiser. Unsurprisingly, NVIDIA is expected to grow over 20% through 2026, and this blew my mind, okay? Because I know they do software, data centers, chips, and everything, but folks, this blew my mind. NVIDIA's net margins sit at 41.2%. That means they make $100 on the top line, they bring 41.2% to shareholders, $41.2 to shareholders. That's nuts. Compare that to AMD growing at 15 to 25%, relatively similar growth rate, but net margins about half of what NVIDIA's are, closer to 21%. Now, don't count the advertisers out like Trade Desk. I do think advertising to consumers is going to be a big deal in 2022 as more businesses try to compete for market share of whatever leftover money people have or their leftover firm buying power. But Trade Desk is expected to grow 25 to 30% over the next 4 years. Net margins around 30 to 33%. Don't count Trade Desk out. I think that's a potentially good one. For comparison, though, Amazon sits at 16% growth through 2025. Only margins of around 5 to 8%, though, on the lower margin side. Unsurprisingly as well, restaurants like the Cheesecake Factory, net margins around just 4.5%. Not a surprise. So I do think certain retailers, restaurants probably going to have a little bit more pain, although they could just trade solely off of COVID news, quite frankly. Anyway, so for me, the highlighter in the stock sector is really probably for 2022 going to be on advertising companies like Google and Trade Desk, products with high margin, because those advertisers are also high margin, but that's a service. Products with high margin, Enphase, NVIDIA, Tesla, they're going to have pricing power, and when we start having a sort of an overwhelming backlog potentially of inventory, they'll be able to lower prices, still get sales, and just shave a little bit off of their margin, but still have very strong and growing businesses. And payment processing companies, honestly, like PayPal and Visa, even though they've sold off recently, I don't know if it's justified. So pay attention to some of these, obviously not financial advice, but these are some of my thoughts. These are some of the companies that I'm looking at and researching in depth. We'll talk more, obviously, in the course member live streams. Folks, thank you so much for watching this video. I hope you're having a wonderful weekend, and we'll see what the market does tomorrow. Thanks again. Goodbye.